3, 2, 1. Welcome to the show.
Here we are again.
Every week.
It is almost Thanksgiving, bro.
I know.
Getting there.
I'm ready for some good food.
Seriously.
Got the kids coming home from college.
Yep. My daughter's coming home this weekend.
Both of ours.
Yeah, can't wait.
Yep. We'll see how long it lasts.
Yeah.
I asked her, like, how much time do you actually think you're going to spend at home? And she's like, no comment, Dad.
Can I borrow the car keys?
Exactly.
Can I have $40 in the car keys?
I told her she's going to have to Uber. She's going to have my truck.
All right,
man. What do you got for us this week?
So try not to roll your eyes. It's a little bit on the dull side, but it's pretty important stuff.
It's never dull.
Yeah,
it's educational.
It is educational. That is true. That's a better
point.
That's a better term to use than dull for sure.
You want to watch exciting stuff? Go watch like
Kramer.
Oh, I was going to say something like Black Rifle Coffee videos or something.
Yeah, well, that too.
Whatever. If you want to watch something exciting.
Yeah, I was trying to stay in the finance section, but I prefer the Black Rifle TikToks.
There's not a whole lot of fun in financial section.
No, not any fun at all.
All right.
Anyway, Consumer Price Index, Producer Price Index, and why they matter to us as investors. They are two of the primary drivers for what the Fed looks at in terms of how it's going to respond to rising inflation. So we'll just go through those real quick so everybody understands what they are and what to look for and kind of where we are now with respect to them. And then there's been a lot of talk about the G Fund, so I got a couple slides of the G Fund that I took from the TSP website, and I just want to kind of talk through some of those things. And then the TSP fund charts. Okay. Consumer Price Index. So, like always, this is from Investopedia. It's a pretty quick read, and there's a lot of stuff in there, so I would definitely recommend checking it out. So, Consumer Price Index, it's the CPI. Here's the key takeaways, right? It measures the overall change in consumer prices based on a representative basket of goods and services over time. It is the most widely used measure of inflation. Okay, the most widely used measure of inflation. So every month when the CPI number comes out, that's why the market is responding, especially now, because if CPI goes up, inflation is going up, therefore the Fed's going to raise rates, therefore the stock market's going to go down. That's how it's been going for the last 6 months. It has a huge, closely followed by policymakers, financial markets, businesses, consumers. CPI, based on an index covering 93% of the population, that's not that interesting. Based on about 94,000 price quotes collected monthly from 23,000 retail service establishments. So this is actually pretty interesting if you ever want to go down the rabbit hole of does the government actually come up with this CPI number every month. There's a whole bunch of, actually mostly small companies that respond to surveys from the government about CPI. It's actually pretty interesting. Housing rents are used to estimate the change in shelter costs, including owner-occupied. The big thing about this, it accounts for nearly a third of the CPI. Okay. Rent. It's basically rent, and it accounts for a third of the CPI. So rent is tricky because usually you rent for a year, right? So if you rented a year ago, you locked in at a much better rate than you would if you were going to rent a house right now, right? So how they calculate, the numbers come out in CPI. So it's a lagging indicator is rent, and it's a third of the CPI. So that's why if you listen to people, they say that the Fed has already tightened too much because the CPI is not reflecting the increase in rent costs because it takes a lot longer for that to work through the system. So these are basically the 8 groups that they look at. Food and beverage, we know, has gone up quite a bit. Housing has gone up a lot, and it's not really reflected yet in the CPI. Transportation, I don't know if that's gone up a whole lot. Education tends to be coming down, I think. Other goods and services have gone up a lot. So you average it all out and come up with the final CPI number. And these are the groups and how they're weighted. So housing is a really big one, but it lags a lot. Commodities is a really big one. Lumber, a lot of the building material commodities were really high in the first half of the year, and they've come down quite a bit. Energy is probably the only sector in the S&P that just keeps chugging higher. So that's definitely contributes to the overall increase in CPI. And so those are the eight. You add them all up, average them out, and you get the CPI number. So bottom line, CPI, very important economic metric, measures the average change in price paid by consumers. Okay, so this one is paid by consumers for a basket of goods and services. Calculated and published monthly by the Bureau of Labor and Statistics, BLS. It is among the most common measures of inflation indicating health and direction of the economy. Serves in other capacities, which is important to us because the government uses CPI to figure out increases or decreases in Social Security and pension for federal civil service retirees. Okay, so that's from the consumer side. The other side of it is from the producer, right? So producer price index measures the average change over time in prices domestic producers receive for their output. So it's a measure of inflation at the wholesale level, right? So the CPI is at the retail level, what we're paying for it. PPI is cost of wholesale. Okay. It's also, reported every month, Bureau of Labor and Statistics. Key takeaways, PPI measures the change in prices paid to U.S. producers of goods and services. It's a measure of wholesale inflation, while CPI is a measure of prices that are paid by consumers. Published monthly by the BLS. PPI indexes are calculated monthly on products and services, industries, and buyers' economic identity, whatever that means, which is also used to calculate overall monthly change in final PPI. Okay. One versus the other, because it gets a little bit complicated. They're both really important economic measures because they point to monthly changes in price, both in terms of the consumer and the producer. They reflect prices from different standpoints, right? PPI is a measure of prices based on first commercial transactions for a product or service, in contrast to CPI, which measures basically what the end product, right? What we're paying for it as consumers. Okay. PPI does not measure, these are like differences, right? So CPI focuses on the final sale. There are some distinctions. Distinctions are, for example, PPI does not measure price changes for aggregate housing costs, right? CPI, shelter is a big part of that, right? So PPI doesn't measure that. But PPI incorporates a weighting of 18% for healthcare products and services, and it's not far off from 20% in the U.S. So in the U.S. GDP. In contrast, CPI's weighting for medical care is below 9% because it doesn't measure third-party healthcare reimbursements. So there's obviously a lot of factors that go into PPI that do not go into CPI and vice versa. Another key distinction is that PPI does not include the price of imported goods, okay, because it's domestic. Conversely, PPI includes exported prices while CPI does not. All right. So why do we care about all this? This was a pretty good article in Forbes magazine that I found that kind of explains it. We all see prices going up in the store. Key takeaways, PPI measures the change in selling prices received by domestic vendors and represents the costs of producing goods, right? How much does it cost? The increase in cost to the vendors to produce goods. CPI measures change in prices consumers actually pay for everyday items. So both reports influence the Fed when deciding whether to raise or lower or hold rates steady, right? That's the important thing. What does the Fed do with respect to inflation? And it does that by really looking at CPI and PPI. So if either the PPI or CPI goes up, right, It signifies that the daily life has become more expensive, right? That's inflation. So for us, when the PPI or the CPI rises, it means we're paying more at the store. Since the Fed has a target range for inflation of 2 to 3%, any movement above this range can force the Fed to raise rates, right? If inflation is above 2 or 3%, the Fed raises rates. It costs more to buy stuff, so people buy less stuff, so the rates come down. When this happens, the stock market is likely to come down as business growth slows and fewer consumers will invest because more of their money is going towards the increase in the cost of living. If the PPI and CPI fall, if they come down, and inflation goes below that 2 to 3% target, the Fed may lower interest rates to encourage people to spend more. This can lead to a boom in the stock market as low borrowing costs encourage businesses and consumers to spend. The result of more spending is higher corporate earnings and higher stock prices. So that's why we want to know about PPI and CPI. And so when you're listening to those numbers that come out every month, that's what you get. So where are we kind of right now? This is a little bit old. In September 2022, PPI for final demands of goods and services increased by 0.4%. It increased by 8.5% year, 12 months from September 2021, ending in September 2022. CPI also increased 0.4 in September and rose 8.2% in the all items index for the 12-month period from September 01 to 02, or 2021 to 2022. Increase in CPI is caused by rising costs of shelter, right, which is lagging, as we said, and food, but tempered by a drop in gas prices. So all these things kind of average together to get the final number. So bottom line, PPI and CPI reports are essential for economists and investors alike. They help bring the blurry picture of the U.S. economy into focus so that decisions can be made to keep us running at peak performance. However, as we've seen, sometimes inflation is so strong and quick that even a small delay in raising interest rates can have an outsized impact on the economy and the stock market. All that investors can do in this situation is pay attention to other economic indicators and take a more defensive stand with their investment portfolio. That's basically saying to go to the G fund.
I was going to say, what do we call defensive? We're going to call that G fund? For us, I think so.
I mean, in normal times, in a 60-40 stock to bond portfolio, defensive means to increase your exposure to bonds. That has not worked in 2022. So the G fund is kind of the best option for us. And speaking of the G fund, I've seen all kinds of conversation on Facebook about what it is, and it is a little bit. I don't have all the answers. I'm gonna have some questions because I don't have the answers about the G fund here. But I took all these slides off TSP.gov, right? So right now there is $210 billion in assets in the G fund, and that includes the pieces of it that are also in the L funds. So in the G fund as a whole, $210 billion. That's compared to about $265 billion in the C fund right now. Okay, so there's a lot of money. There's a lot of money in the G fund. This was pretty interesting, right? Because in everything else we look at, what are the holdings? The G fund doesn't have holdings. The rate's calculated by the U.S. Treasury as the weighted average yield of approximately 181 Treasury securities on the last day of the previous month. So, I mean, there's another slide that says it in a little bit different way, but the interesting thing is there's 181 Treasury securities. If you look, it's 10-year and the 2-year and the 3-month and the 1-month and the 30-year and there's a whole bunch of them, but
I don't
181?
I don't know of 181.
No.
So they know more of them than we do, obviously.
Yeah, they have more. So one of the I'll show it on the next slide or two, but the G fund has to they have to buy non-marketable securities, and
Right.
they're short duration. So as I guess the best thing for us to do is watch like the 1 month to the 2-year yield, which has been going up a lot, which is why the G fund is going up. And we haven't. I don't know if you guys know about yield inversion, but the yield curve inversion, the shorter end of the yield curve, the 2-year and lower, has been increasing in yield, and the longer term has been kind of not increasing as fast, which is why the G fund is going up. So average rates of return. So the orange here, let's call that red, and we'll call this orange. This is the G fund. This is the L income fund. Okay. So, and this chart is actually sort of backwards, it seems to me, but that's okay. Because here we are year to date, and we're going in time to the right instead of the left, which is usually the other way around. But here we are in year to date. The G fund is a little over 2% so far year to date, and L income fund is down here at a little over -4%. That's because the L income fund has a lot of F fund in it, and the F fund has done really bad this year. And you can see how far that extends out, right? So that to the point where over the lifetime, this year has been so bad for the bond funds, for the F fund, that it's basically taken out all of the gains that the F fund has made all the way back to the lifetime of the move. So now the G fund has done better in the lifetime of the whole thing versus the L income fund. It's not supposed to be that way. It's pretty unbelievable. But
I mean, that's a whole nother conversation. Kind of, we could go down a rabbit hole about talking about why that's a big deal.
Yeah.
And why we don't understand so many people kind of completely frown on using the G fund.
Yeah.
But they're happy to put their money in an L fund, which, to us doesn't make any sense, right? Because it doesn't take any consideration into what's going on in the market. It just calculates based on when you think you might retire. So the fact that the G fund is outperforming, L income is what you go into when you retire.
Right.
So if you would have just stayed in the G fund,
you'd have been way better off.
Your whole career.
Yep.
You'd have beaten the L income. That's pretty sad.
Yeah.
I mean, if there's any...
I mean, if you had put this chart up last year, it wouldn't look like this at all.
Yeah.
But,
yeah, well...
but if you're a retiree...
Oh, man.
Yeah, I mean, yeah, it's... if you are not actively managing, and I don't mean day to day, but if you're not actively managing your TSP as a retiree or as almost a retiree, I mean, I don't know what you're thinking at this point.
That's one of the other biggest, fallacies that we get told, from all these folks that should know what they're doing, is they tell us, after you retire, you just kind of like, you'll put it here and you'll live off this, so much percentage and blah, blah, blah. And that's taking I mean, it's better to take it completely out of the market.
Yeah.
If you're just going to not do anything with it.
I mean, honestly, that's why people buy annuities. Right?
Yeah. Yeah. I mean, they don't want to think about it.
If you retired and you have $1 million in TSP and you buy a 5% annuity on $1 million, that's $50,000 a year. And you can live on that, that adds to your pension and all that.
Right.
Then you don't have to worry about it. Now, you have to worry about it with respect to inflation. But everybody's worrying about that. It's not going to keep up with inflation, right?
Right.
Matter of fact, inflation.
Not a recommendation for annuities, just an example.
An example, right. So in terms of inflation, because everybody talks about the G fund is so bad because it doesn't keep up with inflation. The definition actually of the G fund is it's designed to outperform inflation. That's what it's designed to do. So you can see here, since the inception of it, it's done really well at outperforming inflation. I would say this year right here, probably not so much. Inflation has definitely ticked up.
It's catching up a little.
Yeah.
But back out a little bit, because if you were to tell someone, look, you could just put your money in a fund and you're not guaranteed anything. We all know that. But let's just say, for the sake of argument, and you look at that and say lifetime of 4.67. Yep. If somebody said, look, I can guarantee you, 4.5% on your money if you just put it over here in this fund and you don't have to worry about anything. That's not a bad deal.
No.
Right?
It's not bad.
So we poo-poo G fund, but...
Yeah. I mean, it's funny because...
We don't poo-poo G fund.
Yeah, no. I mean,
the greater we
use the G fund as a place to pause while the stock funds are going down.
Right, to protect our money from catastrophic loss.
Right. That's the point, right? So yes, do we get a little bit of a guaranteed rate of return in the G fund?
Yeah.
Yep, and
Which
that's
is
great.
awesome.
Right? It's awesome.
But that's not really exactly why we use it.
Right.
We use it to protect against catastrophic loss, but the fact that we actually get a little something while we're in there is awesome.
It's a whole lot better than any money market or savings account or anything else you're going to do.
You know, we always talk about how when we retired, we put some in IRA and we kept some in the TSP, because the TSP, we can have access to it, in IRA we can't. So that's a short version of why we would do something like that. But in our IRA, we have lots more flexibility. The rules are, the gloves are off. But we also don't have the G fund. Right? We can't, the only place to escape is a money market fund, which is basically a checking account.
Right.
So it's not a great deal.
It's not. I would have done better, to be honest, if I had kept my money in the TSP this year, because trying to make gains on the short side is very hard.
Yeah.
Right?
Yeah.
And I do it. I do some of it, but it's very difficult. And the Fidelity version of the G fund is a money market account, and it doesn't pay anything.
Right.
So most of the time,
it's like 0.0001.
It's like, pretty much. Yeah, nothing. So my account is sitting there pretty much flat for the year. I mean, I've made a little, lost a little, but it's pretty much flat for the year, and it's sitting in an account that's not making any money. Mm-hmm. So I would have been better off if I'd have kept it in the G fund.
Yeah, but you don't know that,
right, Right.
So and you wouldn't want it sitting in there in the TSP if when the market swings back the other way,
right, for sure,
because we can make a lot more money that way.
Right.
So
right. All right. Last thing about the G fund. So why did I put this chart up? Yeah. Short-term securities. Okay. It's just short-term securities. So the two biggest takeaways for this was short-term securities, and by law has to be invested in non-marketable U.S. Treasury securities specifically issued to the TSP. So I haven't figured out.
That means you don't get access to them. Right, the average person can't get out. That's what non-marketable means.
Right,
it's not on the market. It's not available to other people. So these are securities they built just for the TSP. Right. So that makes sense. Right, they're not accessible to everybody. So we don't have access to 181 Treasury securities. Right.
The thing that is annoying, though, if you're trying to figure out what it actually is, like it says composition, I haven't been able to find out exactly what it is.
Well, you're not gonna.
No,
they're not gonna tell you.
They don't want to tell you. And the other one I wanted to go back to real quick. Because there's a lot of talk, and I don't know how this happens, but the G fund, when you look at it on the TSP site, it changes every day, right? Your rate of return changes, but yet the G fund is calculated by the Treasury as a weighted average, yada yada, the last day of the previous month. So it's once a month. So how the G fund changes every day is something that people ask quite a bit on Facebook, and I have no idea what the answer to that question is.
If anybody can figure that out, we'll buy you a cup of coffee.
Yeah, I mean, I don't know it because from their own rules, they're saying it's a monthly number. So I really don't know. Okay. If you guys have questions about the G fund, hit us up and we'll do the best we can.
Yeah.
All right, TSP fund charts.
TSP.
So we are recording this on Friday. This is the weekly three-year C fund chart, and it's as of the close on Thursday. As of about 1 o'clock on Friday, it's going to be pretty flat for the day. So I think these numbers are going to come out pretty close. Last week we did get above that 20-week moving average line, and this week is pretty much flat. So we are going to close the week above it. Does that mean we're getting support and we move higher? It's possible. So this is actually a great place to be in terms of making a decision. You got RSI right at 50 there. You got MACD rising. Do we get support here? If you think the market's going to go higher, this is a good place to buy it. Why is it a good place to buy it? Because you can really define your downside risk. If you buy it there, at say 39.46, you're going to sell it if it gets below that blue line. So your potential gain say it can go up to, 44, 46, 4,800 for a new high. But your potential downside is whatever is just below that blue line. So from a risk reward perspective, that's how you would look at it.
You also have to be prepared to get in and out, right? So you're going to lose your moves.
Yes.
I mean, that's the part. That's the reason why we don't always jump right in and out like that,
Right.
because we're going to wait it out and get more confirmation on the larger trend, right? I just want to point that out for those. We always got new folks, watching this, and if we could have as many moves as we want, that would be easy.
It would be.
That's how you'd play it. You'd literally just bounce it on that moving average,
Right.
right? You'd say, okay, I'm in, I'm out.
Yeah.
I'm in, I'm out.
I mean, on a weekly basis, you can kind of do it because it's, say, 4 weeks in a month. So you only have 4 opportunities, and you have 2 or 3 IFTs, depending on how you look at it.
Right.
So on a weekly basis, you can kind of do it that way. And then, of course,
you just got to be prepared. And you can always go to G, which is the
Right.
fallback. If you hit that, if you crash back through that line and it's going back down again, you can get out.
Yeah.
Now, the part sucks about that is if you do it at 1 o'clock today,
you get tomorrow's closing
right,
price.
you get tomorrow's click. So you have no idea what's going to happen between noon today all the way to closing tomorrow.
Yep.
That always irks us.
The noon rule is worse than the 2 IFT
It is.
rule.
It is. I'd rather just be able to get that, whatever time I trade, that's what I get. And still have 2 moves. That's fine.
Yep. All right. But at any rate, like we keep saying, and you can kind of, I don't know if you can see it here. One of the other things to watch for is the angle of that blue line, because if price is above it, the blue line will start to rise. So right now it's curving in the positive direction, and that's a good thing. When we're above it and it's curving down, like right here, right, that high, it never turned up, right? At least the next one, the next high there is August. At that point, the line did start to turn up, so it was a stronger move. But if you're looking at this on a longer term basis, you want to be in when that blue line is angling up. Okay, S fund, pretty much same kind of thing. We're very close on RSI to 50. MACD has already turned positive, and we're right there on that 20-week moving average line. So if you're listening to the news, everything is bearish. Everything. So if you're listening to the news and you're making decisions based on that, you're not going to buy it here. If you're looking at, seasonality, we know that for the stock traders and institutions to make any money, any bonuses at the end of the year, they have to push stock prices up. A lot of people think that's why the market goes up in November and December. That's where the Santa Claus rally comes from. I mean, all that might be true. And since we're going into that time of the year, can prices get support there at that 20-week moving average line and keep moving higher? Yep, absolutely, it's possible. But you have a risk-reward line there at that 20-week moving average line, which is great. It's a great place to be. iFund looks much different than the other charts, right? iFund had a big breakout. We actually bought into the iFund last week. I guess it was sometime early last week. There's a lot of reasons that the iFund, the biggest reason that we've talked about it before, the iFund does well when the dollar is going down. So the dollar has fallen off quite a bit, and that's why the iFund went up over the last few weeks. So it's the only one right now that's above its 50 RSI. MACD is looking much better than the other 2 stock funds, and we have definitely broken through the downtrend line and the 20-week moving average line. The downside of this, as you look at it, you go, great, that means I should buy the iFund. Not necessarily, right? I'm not recommending one or the other. There's a lot of things look good in this chart. The downside is that now if you bought it here, your risk is really big.
Right.
Right? It
and
goes
the
all the way
farther
down.
it goes up, the more your risk increases.
That's right.
And it's all about whether you're comfortable with that risk, right? I mean, it's not a bad chart. It's just that the risk, when we bought in it, where were we at when we bought?
Right on the day that it came over the 20-day moving average line. So it's like back there somewhere.
Right. So we had a low risk And that's one of the reasons why we did it.
Yep.
And so, that worked out well, but we did it at a low risk point. We didn't do it now.
Right.
And so if you're considering that, that's what you just got to take into consideration. This isn't me or us trying to talk you out of it, but you do have to consider it. This is how, we get this question all the time. What if I miss the alert? What if I'm not a member? Then I become a member and I'm not synced up with you guys? Well, these are the decisions you have to make. We do this every week. You get a much deeper dive in the analysis on Sunday night. Jerry puts all the stuff together. And then you got to look at that and say, okay, where am I at? What's my plan? What moves am I going to do, until, quote unquote, we are synced up. And then there are lots of members who aren't synced up.
Right.
Because their risk level, their risk tolerance is different. Their analysis is different. Whatever. But they're actively managing it, and they're using us as kind of a healthy validation.
Right.
And so it's absolutely some people, like on the last move, might have gone more into the iFund than we did.
Sure.
Right. Instead of, because we hedged a little bit. Right. No problem. Right, they're winning. Right?
Yeah. Oh, yeah.
So just try to take time, and this is again for those folks that are generally new, which we always have.
Yep.
When Jerry's talking about that kind of risk level, that's where you want to peak up. Pay attention, because that's how you determine. Okay, should I go in? Okay, well, what's your risk tolerance?
Right.
Are you ready to say, oops? I made a poor decision because the trend changed. Now I got to get out. Okay, those are 2 moves.
Right.
That's okay, but you need to understand all that.
Yeah, and we, if you're a subscriber to the site, we do the analysis on daily and intraday charts to ultimately make trading decisions.
Yeah, and better. So, I would say better decisions, but
because you have to pick a day to do it on, right? So when we on the show, we're showing a longer time horizon. You can apply the same methodology. It's just that
still works.
It definitely works, because we're doing the same thing on a daily basis to make reallocation decisions. So if you want that time frame level of analysis, definitely hit us up at growmytsp.com. F fund. We also got into the F fund. We got into the F&I last week or the week before. We've been talking about the F fund for quite a while. It is in this ridiculously historic bear market right now, and it is long overdue for some kind of a rebound. And we've got it in the last couple of weeks. What I'm in the big scheme of things, this was the top back here in 2020. And so in terms of Elliott wave, you got a 1, 2, 3, 4, 5. So this, if you bought down here, it's reasonable in terms of an Elliott wave projection, right? And then after that, this rally week right here, you had a confirmation of that bottom. So that's great. Now you have upside resistance at that downsloping 20-week moving average line. You're also going to have resistance here at that prior low. But in terms of Elliott wave, we want to see it do A, B, C back up to the prior wave 4, which is up here at about 103. So my upside target for the F fund is about 103, and we'll see if we get there. We got a long way to go in RSI. MACD just crossed positive. So ordinarily, we were always talking about how we want to see RSI get above 50 and MACD turn positive. So why would I get into the F fund, back here when RSI was clearly below 50 back then? Because I'm doing it based on an Elliott wave projection. And my risk tolerance, so I do that Elliott wave projection, and I get a confirmation of this low because it was banging on it for 1, 2, 3 weeks before it rallied and broke out higher, right? So there's a lot of things to look at, and that's what kind of goes into the analysis and the alerts that we put out to subscribers. Okie dokes.
Questions. If you have any questions, you can always put them in the comment section wherever you find this video. You can also, if there is no comment section, you can shoot us an email at support@growmytsp.com. The customer support team will move that over to us if they think we can answer it. If they don't think we can answer it, they might not answer it. No, I'm just kidding.
We may answer it one way or another.
We'll answer it. Usually if it's like specific advice, we can't do that over email.
Yeah.
So I hope you guys are having a great weekend. Hope everybody's ready. You will not hear from us until after Thanksgiving.
Yeah, I'll be up on, well, the members only, the market update will be on Wednesday.
Yeah, we'll have some stuff going out next week. But with that said, hope everyone has a great Thanksgiving holiday. Hopefully, if you don't celebrate Thanksgiving, have a great week. Anything else?
I think we're good.
Boom.
All right.
See you guys.
Out here.
Enjoy it.